I think for the most part, everybody who's invested in these cryptocurrencies are okay with that shift that, hey, it's maybe not really necessary for anonymity, however you say it.
Was just watching Finding Nemo 1 or 2, or I don't know which one it was, with my kids, and like seeing enemy. I'm like, and because I can't say it either. Anonymity, I can't say that. Anonymity, it's a hard word to say. Anonymity, there we go. Trying to get that to work.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax. Brought to you by BKD CPAs and Advisors. Everyone needs a trusted advisor. Who's yours? Now here's your host, Damien Martin.
Hello and welcome to the 75th episode of Simply Tax. On the podcast today, we're doing some blocking and tackling on blockchain and cryptocurrency with BKD's Nik Fahrer, who brings the tax perspective, Caleb Shough, who adds the financial reporting side of things, and Katie Harrison, who brings regulatory compliance perspective. Virtual or cryptocurrency is something that we've discussed on the podcast before, and like many of the topics we've covered, is complicated, evolving, and fast-moving in terms of developments, all at the same time. Or as guest Dr. Sean Stein-Smith put it in episode 18,
those sort of underlying characteristics make this whole area very interesting, very exciting, but also does, I think, raise a lot of uncertainty and questions.
But while the space is no doubt fast-moving in terms of developments, the biggest thing that the tax world is looking for and still waiting on is some much-needed guidance in the area. Here's the update on where we currently sit in terms of guidance from guest Ed Carl from our discussion in episode 66.
Nothing's come as yet. I think maybe the commissioner was hopeful that something would be released. So if the commissioner is going to bring it up in a public speech, then I suspect that something's being worked on. And it's not at all uncommon for guidance to come out a little bit later than people internally at the service expect. Sometimes the various reviews by OMB or by Treasury take a little bit longer than they expected. So the fact that he mentioned it is good news. I think it's just going to be a little bit longer than he expected.
So, we're still waiting on guidance. But that doesn't mean the IRS isn't taking compliance seriously. On July 26, 2019, the IRS announced it was expanding its efforts involving virtual currency, and that they were sending out 10,000 letters to taxpayers reminding them of the tax treatment of virtual currency transactions. But what is that tax treatment anyways? Before we get to all the challenges that come with reporting it, and that tax treatment, let's start with what cryptocurrency is and why it matters. As you probably know, I'm a guy that likes examples, so let's start our exploration into this virtually cryptic area with Nik, discussing one of the many types of cryptocurrency that are out there, Bitcoin.
So in 2009, Satoshi Nakamoto created Bitcoin. You know, who is Satoshi Nakamoto? We don't really know. It's kind of a username to say for either a person or group of persons that created Bitcoin. And actually, cryptocurrency as a whole kind of goes back even further than Bitcoin. Bitcoin is probably the most popular and most well-known cryptocurrency, but there's been a lot of research and there were some examples. They weren't really put into play, but that date back even to the 1980s and 1990s.
Now that's interesting. I mean, I don't know about you, but the frequency and the way in which Bitcoin is discussed today kind of had me thinking it was something newer than that. But as Nik just told us, it is in fact 10 years old with roots much older than that. Let's hear more from Nik on the goal of Bitcoin and cryptocurrency in general.
So there's a few different characteristics of cryptocurrencies that really they were trying to, the founders of cryptocurrency were trying to solve. And one of those being peer-to-peer. And the reason that the creators of, let's say, Bitcoin as an example, created Bitcoin is because they felt like the cost of banking in today's world is way too expensive. And how can we circumvent those costs? Well, by creating a peer-to-peer cashless system. And basically what that means is me, Nik, I can send money to you, Damien, without interacting with a bank at all. And so it kind of circumvents this idea of, well, if Damien, you're in a foreign country, let's say Japan, for example, and I'm in the United States, I would normally have to go to a bank, initiate a wire or an ACH. They would charge me for that. They would charge me a wire fee, and it probably wouldn't get to you for 3 to 5 business days. Whereas in Bitcoin, for example, and several other cryptocurrencies, I can send you money almost instantaneously, and there's no intermediary there.
Okay, so now we know when it started and what they were trying to accomplish in creating it. Let's now hear from Caleb Shough on what cryptocurrency is.
Blockchain or specifically cryptocurrencies essentially are a virtual currency. So there's no physical portion of it that really work through what's called encryption or cryptography. And essentially, the way I like to think of it is if you compare it to like a coin back when money was first getting started. So the three real properties of money or of a currency is that it has a unit of account, that it stores value, and that it's a medium of exchange. So maybe put them side by side. So in a coin, you have a unit of account that would in US would be like 1 penny. So it's like the lowest denomination of a currency. And in blockchain, you have the same thing. So for Bitcoin, that's a Satoshi. For Ethereum, that's a Wee, but it's still a particular unit that is indivisible that can be accounted for. So that's the first step in defining what a currency is and why virtual currencies matter. The second attribute of money is a store of value, right? So if you think back in the old days, coins were printed in gold, and gold is scarce. And because gold is scarce, money had value. In the crypto world, the units of account, the virtual units of account, are scarce because whenever the program was developed, they limited the supply, or they set the inflation rate as a fixed inflation rate. And it would require a majority of the whole entire network to change that amount. So you get the scarcity baked into the cryptocurrency itself at the beginning of the cryptocurrency. The final aspect of money is just a measurement of exchange. And this is where we really haven't come to fruition when it comes to cryptocurrencies because of how, first off, it's not accepted everywhere. So you can't go into any store and pay with cryptocurrency. And then second off, the valuations of these things are all over the place. And so that makes it hard to be a day-to-day transactional currency. But it's got all these properties that coins did and still do have, but it makes some improvements on that. Essentially, instead of having a government that mints your coins for you, there is a non-thinking, non-political entity that is issuing the currency. So when you talk about things like monetary policy, well, that's already baked into the system. Like there's no one making decisions about that on a day-to-day basis like our Fed is, for example. The final thing is just the security and knowing that once a transaction is finalized, that it can't be reversed is a big deal in cryptocurrency.
I mentioned at the start of the episode that cryptocurrency has been evolving. Here's Katie on the evolution that we've been seeing in a key aspect of cryptocurrency that led to its creation.
At first, it was created for people to be able to invest their money in an anonymous way. And I'm sure there was also devious intentions behind a lot of the cryptocurrency exchanges as well, when it was out on the dark net and that type of thing. But consumers, particularly as Bitcoin, kind of increased in value, and people started looking at it as an investment tool. And like I said, they want to start using it in the marketplace. They want to be able to do that. And the only way they can do that is through a cryptocurrency exchanger. And these cryptocurrency exchangers, they are, legitimate businesses. They try to follow all the regulations that are applicable to them, and they do. But the biggest thing is that the anonymous thing that people really desired in the very beginning 10 years ago has to go away because there's a verification process and that sort of thing. And I think for the most part, everybody who's invested in these cryptocurrencies are okay with that shift, that, hey, it's maybe not, we're not necessarily going to be anonymous anymore, but that's okay because we want to use it in a different way. We've gotten some sort of return on our investment. Now we want to actually exchange it and use our return on that investment to, maybe buy another investment in some sort of other industry. So I think, consumers in general have been okay with the shift of what the original intent for cryptocurrency was to what it's becoming here, 10 years later. I think for the most part, what I'm hearing from like the seminars and out in the field is I think most people believe that all the cryptocurrency types that are out there will eventually shift and and maybe only 3 or 4 will remain. Most of them will probably fall off. So I would say we're kind of looking for that to happen here in the next 5 years or so.
Armed with our understanding of where it came from and even how it started to evolve and change, let's hear from Nik on our favorite aspect of cryptocurrency, and that's simply tax.
We really don't have very much guidance on cryptocurrency from the IRS. We have one notice that was issued in 2014. That's notice 2014-21. And in that notice, Bitcoin is the only example that is brought up. So really, we don't have very much guidance at all. And really, the essence of the notice was basically the IRS just telling us that they recognize that there's virtual currencies out there and that there are transactions going on in today's world involving virtual currencies, and that those virtual currencies are recognized as property by the IRS. Basically, what that means, in a sense, is that the IRS isn't recognizing these cryptocurrencies as actual currencies and what they're essentially designed to do. And because of that, there's a lot of tax implications for not being recognized as a currency. So, for example, if let's say I'm a miner and I mine Bitcoin, that Bitcoin that I receive is going to come into me as ordinary income, likely reported on my Schedule C of my individual tax return, which may also be subject to self-employment tax. So in that example, there's not really much that's different. If I get paid for a service or a good, I'm going to report that as ordinary income. But since cryptocurrency is viewed in the eyes of the IRS as property, if I then take that cryptocurrency that I've mined and then trade it for another cryptocurrency, it's a taxable transaction. If I take cryptocurrency that I already own and I go to a merchant, say Starbucks, and buy a cup of coffee, that's also a taxable transaction because the cryptocurrency is viewed in the eyes of the IRS as property.
So that's the tax side of the house. But what about challenges for financial reporting? Caleb, could you help cut through the static of that one?
Yeah, definitely. And there was a lot of unknown about how you report for these. And we've started over since 2017 to emerge a little bit of consensus on what the proper accounting for them is. But if you think about it, like if you're a miner and you're mining cryptocurrency, well, the crypto is kind of like inventory to you, but it doesn't really fit within the GAAP guidance for inventory. So that didn't really work. Well, you think, okay, well, crypto is kind of like an investment. Like I'm expecting my crypto to be worth more, maybe 1,000 times more in a year than it is now. But then again, it really doesn't meet the definition of a security under GAAP either. And so what the industry has really kind of come to the conclusion that they should be accounted for as intangible assets until we get something more clear from the FASB or GASB that tells us exactly how to account for them. It's generally being accounted for as an intangible asset. Now that in and of itself has some problems because you have to value that intangible asset and what's the best method of valuing that and where do you get your pricing data from and when do you price it? Like a crypto market is happening 24/7, and so there's no close of business day. And so just timing of when that crypto is valued is important, especially in today's day and age where crypto values can change very rapidly in the course of an hour or two.
So obviously, there are some areas of uncertainty that come with the territory of being a new and evolving area. I think it's also fair to say that there's a good amount of misconception and misunderstanding out there with cryptocurrency as well. Here's Nik to boil some of these down for us.
Even going back a little bit, I think that there's a lot of misunderstandings when it comes to cryptocurrency to begin with. If we even go back to what cryptocurrency is at its basic definition, really phonetically, it's the combination of two words, cryptography and currency, right? So cryptography is really just this digital way of protecting information by encrypting it. And then a currency is really just a medium of exchange. But if we understand what currency or money is to begin with, it has to be generally accepted, right? So if nobody accepted that Bitcoin or Ethereum or Litecoin or name your cryptocurrency was worthy of value, then we wouldn't really have these cryptocurrencies. One of the examples that I really like to use is, can you imagine the first time that somebody tried to pay with a credit card? Right? They probably went up to a vendor and the vendor said, that'll be X amount of dollars. And this person tried to pay with a credit card, and the person behind the counter probably looked at them very weird, and they're like, that's not money. That's just a plastic card. Right? So as we evolve over time, and even if we go back before credit cards, we had the US dollar that is printed by the US government and the Federal Reserve. Even before then, we had, gold coins. And when we went from gold coins to a piece of paper that said, this is how much gold I have. And then we went from there to, what we kind of view as money today and dollar bills. And it's just money evolving over time. And so what I really think that we're seeing in cryptocurrencies today is that we're evolving from the idea of our money being tied to our debit card or a credit card to basically everything is digital. And even going a step further and saying, not only can we digitize money, but we can create better economics. And what I mean by that is Bitcoin, for example, and several other cryptocurrencies use kind of the same economics, is that Bitcoin supply is limited to 21 million. And what that does is it basically eliminates the need for a Federal Reserve. And we know that 21 million Bitcoin is the only amount of Bitcoin that can ever be in service. We can never have any more, with the caveat of a hard fork. And we can kind of get into that a little bit later. And so it's decentralized. And that's really what is so unique about cryptocurrency, is the decentralization. There's no one party that's in charge. It's a group of nodes or computers. And so in other words, it's the people that own those computers or nodes that are in charge. So it's us. We are in charge of our own money, which is so fascinating and so outside of the norm right now that it's kind of hard for people to understand that. And another, I think, hard thing for people to understand is that you can't touch it, right? If I own a piece of cryptocurrency, I can't touch it. It's just a piece of code, really. At the end of the day, my Bitcoin, my Ethereum, my Litecoin, what have you, it's just a piece of code. And so it's been referred to as the Internet of Money. And so if I own X amount of Bitcoin, I can only see that on the blockchain. And we won't dive too much into what the blockchain is, but it's basically just a ledger of all the transactions that have ever occurred in Bitcoin's history. And so the only way that I can really see that I own Bitcoin is because it's on the Bitcoin blockchain, or in other words, it's on the ledger. So it's so new and so against what we're all used to, and especially those people who love to hang on to cash, still get their paychecks and take them to the bank and cash them every week instead of direct deposit. So it's new concepts, and the more we get into it and the more you use it, the more you'll kind of understand it. And so that's why there's just a lot of misconception about cryptocurrency to begin with.
Let's hear how the evolution with cryptocurrency is impacting the financial services space.
When you think about getting a loan or setting up a savings account, your mind automatically goes to, or traditionally it's always gone to, well, I need to go to the bank, to get those items. And that's been the case for the last 2 centuries, since the late 1700s when the first bank was created. Is if you need some sort of financial service for your family or for yourself, you're going to make a trip down to your local bank or, wherever you bank with. And this has always just been a given, I guess, if you will. But, in the last few decades, the face of financial services has just gradually started including non-banks that offer financial services as well. Particularly in the last decade, and really just like over the last few years, a huge shift has occurred in which, consumer demand has just become so convenience driven. We want everything right here, right now, as convenient as possible, and right here at our fingertips too, which this has led entrepreneurs to kind of come up with inventive ways to offer these financial services in a convenient manner. So that's how you get all these startup companies and that sort of thing. There's already out there on the market apps for vehicles for savings accounts and online lenders, cryptocurrency exchanges. These are all examples of financial services that are more, technology driven than what we in the last couple centuries have traditionally believed to be our bank products. The financial services industry as a whole has always been highly regulated, a lot like other industries, but particularly just because, the consumer's money is on the line. So the regulators have always been honed in on financial institutions. Specifically, there's consumer protection laws as well as FinTech regulations are 2 of the main areas that are the primary focus, I guess, if you will, of the government regulators when they're scrutinizing a bank or a financial institution. As the services we've been talking about become more technology-based, we're seeing non-banks and other companies become subject to these consumer protection regulations, that the regulators usually just apply to banks, as well as the FinCEN anti-money laundering regulations. Now, we're seeing this happen in 2 different ways. So the first way is a non-bank is developed. So, you're a FinTech startup company, if you will, or an app, and it offers some sort of financial service. And then the second way we're seeing this happen is a non-bank entity has partnered with an existing financial institution, credit union, and becomes indirectly regulated through that partnership or that relationship. So, as we see all these emerging companies come on that are offering financial services, it's vastly changing what we've seen in our minds as far as like bank compliance. So it's made us as service providers to banks have to change the services we offer and kind of have us evolve as well.
Banks and service providers like accountants aren't the only ones evolving as a result of some of the developments and the increased interest in cryptocurrency. Entrepreneurs are also seizing the opportunity to innovate in this area as well. But as Katie tells us, it's not as simple as having a great idea.
when they start off, and they have this great light bulb go off in their head for this idea for a savings vehicle, for instance, I don't think they realize the compliance that's going to have to come with that particular product. They're typically entrepreneurs that are technology minded, and so they're looking at like the technology aspect rather than what particular legal problems or compliance regulations go with the actual product that they're offering. So I think there is like that huge misconception for the most part. If it's an entrepreneur that wasn't necessarily in the financial services industry before and they're more a technology background, they definitely, I don't think, realize what all is in store for them as they get their startup going and get on the market and that kind of thing. Same thing with the non-banks that partner with a bank. I don't think they realized, a lot of them kind of think that they're skirting around consumer protection regulations because, hey, I'm not a traditional financial institution. I can get around it. When that's just not the case. There's stuff, even if they don't partner with a bank, that they still have to follow, particularly those FinCEN regulations that I was referring to earlier. But especially if they partner with a bank, all of a sudden they're basically acting as if they're the financial institution. So they're subject to those same regulations, and it's hard. I think, at least for our clients that we've worked with, everybody's always so nice and cooperative and try to understand what we're talking to them. But, sometimes it's like a deer in the headlights, like, oh, we're supposed to be doing this? No, we didn't know that. So, I think it's just educating those entrepreneurs that have started these companies and offering these services.
Speaking of education, there are many terms of art that are specific to cryptocurrency and blockchain that can make it seem somewhat overwhelming, and I don't think I'm the only one that feels that way. Let's tackle some of these terms and the complexities that come with them on the tax front with Nik, starting with mining.
Mining, at its core function, in a sense, is similar to mining gold, where we have this finite supply of this thing in the ground that we're trying to get. So in essence, when it relates to cryptocurrency, I have a computer or a node. A node is kind of interchangeable for basically a computer that's trying to solve this riddle or this problem to create new Bitcoin. We'll say Bitcoin as an example. So if I want to mine Bitcoin, I'll have to go and buy these certain types of nodes, computer kind of technology, hardware. It's hardware. And take that processing power and try and solve this algorithmic problem to create a new block in the blockchain. And so my reward for taking all this computer hardware and putting it towards trying to solve this algorithmic problem is Bitcoin, and it's new Bitcoin that gets released into the system. So right now, every 10 minutes, on average, every 10 minutes, a new block is mined in the Bitcoin blockchain. And so about every 10 minutes, 12.5 Bitcoin is created. Now there's, within the coding of the Bitcoin open source protocol, it's basically halved every 4 years. So that 12.5 Bitcoin reward will get halved in 4 years. And so that's how we create this finite supply of 21 million, as we keep dwindling down that reward. And so in I think a little under a year, that 12.5 Bitcoin reward will now be shrunk down to 6.25 Bitcoin every 10 minutes. And so you may be saying, well, wow, 12.5 Bitcoin every 10 minutes. You take that times the US dollar price right now of about $10,000. It's quite a bit of money, right? So I'm going to go home, after this conversation and start to set up this computer stuff that I need to do to mine Bitcoin. Well, it's not really that easy. There's protocol in the Bitcoin system basically that says the reason why on average a new block is mined every 10 minutes is because there's this thing called a difficulty. And the more computing power that comes into the system and tries to mine the Bitcoin, the harder it becomes. And so it adjusts. So if there's so much computing power that a block gets mined in 7 minutes, the next block, and it's not really the next block, it's adjusted every about 24 hours. So in the next 24 hours, it'll be adjusted to where it's even harder to mine a block in the Bitcoin blockchain. So really how it is now, the difficulty is at an all-time high because so many people are trying to get into the space that you have to have so much computing power to mine a block by yourself. There's these things called pools, and what these miners are doing is they're pooling all their computing power together to give them a better opportunity of mining a block. And so those pools then distribute their reward to all the different people in that pool. So it's an incredible amount of computing power. Me or you could not set up one computer and expect to mine a Bitcoin block right now. It's seemingly impossible. You have to have several different computers and all of this computing power together in order to even have a chance. And so when I talk about mining, really your cost there is your electricity, because it requires a lot of electricity to keep these computers running all the time and trying to solve this algorithmic problem all the time. You know, there's been a little bit of backlash about how much electricity costs are involved with mining Bitcoin. And so it's almost like people are trying to solve this problem of, can we create cryptocurrency around, but solve the issue of all the electricity that it costs? And I read a comparison. The comparison was that if you combine all of the electricity used to mine Bitcoin, it is equivalent to what Ireland uses. So the entire country of Ireland uses the same amount of electricity output power as it takes, as all of these Bitcoin miners are using right now. So it's quite a bit.
Let's next turn our energy to hard forks, which I think Nik does a great job of explaining.
So a hard fork is essentially like a stock split. And we'll go back to Bitcoin as an example because it's probably the most popular hard fork is called Bitcoin Cash. And that happened on August 1st, 2017. So what basically happened is there were people that were in favor of Bitcoin, but they wanted to tweak the code just a little bit. And essentially, when it got to a certain block, they said, okay, we are going to split off of Bitcoin and create this now Bitcoin Cash. And the Bitcoin protocol is open source. So these new people said, we're going to tweak the coding a little bit, try and make it a little bit of a better cryptocurrency, and kind of split off and created this new cryptocurrency. There's, quite a bit of technical stuff that's involved as well. I'll try not to get into that too much, but basically if you can think about it as a stock split, and now we have Bitcoin and Bitcoin Cash. And if I owned Bitcoin before it forked, I now own Bitcoin and Bitcoin Cash in equivalent amounts. So if I owned 5 Bitcoin, I now own 5 Bitcoin and 5 Bitcoin Cash. But I didn't have to do anything. It just is basically almost created out of thin air, if you will. So there's a lot of kind of reporting issues when it comes to hard forks, and we don't have a lot of guidance about it. And so a couple of different ways you can kind of handle it, and how I've seen is at that hard fork date, I can say that I now have 5 Bitcoin Cash, but I did nothing to receive those. So I'm not going to report a taxable transaction until I sell them. But I also, when I sell them, have no basis in those. So essentially, if I sell that 5 Bitcoin Cash that I talked about that I received in the split for $10,000, and I didn't report it on the date of the fork that I created a taxable event, but I'm selling it now, later in a later year, I have a $10,000 gain because I never picked that up in income to begin with. Now, another option is I could say on the date of the fork, I received 5 Bitcoin cash. The value of that Bitcoin cash on the date of the fork is my basis, so long as I pick that up in income in the year of the fork. And then in a later year, when you go to sell that forked Bitcoin cash for $10,000, your gain will be $10,000 less the value of it on the date of the fork.
All right, let's take a hard fork here and talk about another area of uncertainty on the tax side: wash sales.
So the IRS says that wash sales relate to stock sales only. And because stock and security sales, I think is the exact wording. And because cryptocurrencies in the eyes of the IRS is viewed as property, you could make an argument that wash sales don't apply to cryptocurrency. So let's say, for example, in 2017, when cryptocurrency was going crazy and basically parabolic, and I bought Bitcoin at its peak of almost $20,000 and held on to it to its, came down to about $3,000 just recently in the past few months. I could then sell my Bitcoin for $3,000 and have a $17,000 loss, and then turn around and buy one Bitcoin almost immediately and be able to take that $17,000 loss, recognize $3,000 of it in the current year, and then carry forward $14,000 of loss to offset any capital gain in the future. Now, granted, that's probably an aggressive stance to take, so which is why we need some guidance. But I have seen that stance taken, and you can make an argument and kind of understand why people would want to do that.
Now, of course, cryptocurrencies are only one application of blockchain. Let's get back to Caleb to hear some of the other ways blockchain has been making headlines and developing.
I like to think of it in two different ways. You have cryptocurrency, which is a digital representation of an asset. So it can be like a Bitcoin that doesn't really represent anything in the real world, but you can also have a token that maybe is a portion of a real estate investment. And you can have that on the blockchain. And so that's one area. The other area that we look at from an accounting standpoint is when they use blockchain technology, a company uses blockchain technology in their back-end processes. So this might be for supply chain, or there's some ideas out there about settling derivative transactions on the blockchain or stocks on the blockchain or stuff like that, where it's an internal process that uses that technology. So we split those into two. Cryptocurrencies it's really easy to create a cryptocurrency. I can do it in about 15 minutes. And so there's not a high barrier to entry there. But also it's hard to get a lot of market penetration if you're trying to start a cryptocurrency, because there's big names out there like Ethereum and Bitcoin. So that space is pretty highly developed from just a currency standpoint, where we're seeing a lot of lag and a lot of hype is in the back end technology. So like supply chain and the derivative transactions, like I was talking about, like that's just taking a really long time to develop, a lot longer than I think people thought it would. And so I still think that we're a few years out before we see a lot of applications on blockchain that aren't just pure cryptocurrencies, that are really meaningful and have high number of users and are really impacting the industry.
How about ways that financial institutions are partnering with FinTech companies? Here's Katie on what she's seeing.
There's a slew of risks always whenever you partner with any company that you don't have any sort of management decision making over them. But particularly if you're talking about a financial institution partnering with a fintech company, we're seeing that more and more as, like I said, the typical consumer in the last 200 years, when they wanted some sort of financial product, they would go to a bank. As that's shifting more and more towards a technology-driven product, there's really no way for a financial institution to keep up or compete in that market unless, one, they partner with an existing, company that's offering it in a technology way, or if the financial institution themselves kind of rethink what they're doing and change their structure a little bit. Well, for a traditional financial institution to do that, it's just, we're seeing it be not very cost effective. I mean, it costs millions for a bank to kind of change their ways, if you will. Whereas it can be profitable for them to actually partner with a fintech company and let the fintech company handle the technology side, right? And the financial institution can handle the actual financial service or the backing of that financial product. So that's really the main thing that we're seeing, simply because there is a symbiotic or a mutual benefit to each party in that particular relationship. Now, as far as if my client is the financial institution, I'm telling them, look, you have compliance risks, you have legal risks, you have reputation risk. All of those associated with you are, like I said, you are partnering with a company that you don't really have managerial decision-making opportunities on. You have no control over that particular company. You have control in the aspect of you can cut off the relationship if it's not working, but there's still going to be a period of time where you have no control over what they're doing, and your faith is just in them and what your due diligence has been before you entered that relationship. So, we always advise board of directors and executive management of those particular risks. So legal risk obviously is just, like I said, they always have an operating agreement with this particular partnership. So that financial institution is relying on this fintech company to do a certain number of things. They have rights and responsibilities, both party does. And so this financial institution is relying on the fintech company to do what they say they're going to do in this agreement. And if they don't, the financial institution is then, depending on what the particular responsibility is, that financial institution can be up for legal risk and, end up in the courtroom for something or other that this fintech company has done and shouldn't have done. Reputation risk, of course, reputation for financial institutions is huge, right? That's how they get their deposit holders. That's how they're able to, the more deposits they have, that's how they're able to loan. So, let's use Wells Fargo as an example. Wells Fargo has had to do huge reputation mitigation because their reputation out in the marketplace has really been hit due to all the compliance problems that they've had in the past few years. And so I don't know, I think it was like December 2018, they came out with this whole marketing campaign to say, look, we're sorry, we messed up, but please still trust us with your money. And so that's a perfect example of what can happen if your reputation goes south and the money, and of course, Wells Fargo has the money to run that sort of campaign. Your local community bank isn't going to have their money. So a hit to their reputation like that could actually shut down a bank. So that's why it's really important that whoever they're choosing to partner with a fintech company, that they know that they have integrity, that they've done proper due diligence, and they're just monitoring them on an ongoing basis to make sure this particular company that they've partnered with is not going to injure the financial institution in some way.
There's clearly risk in a partnership in this space, and as Katie pointed out, in partnerships in general. Here are some best practices for approaching partnerships to balance the management of cost, risk, and keeping up with the fast pace of change in the blockchain and cryptocurrency space.
I really think a lot of this stuff happens at the very beginning. I think that most financial institutions will know if they're partnering with, and this is just based on my experience and what I've seen, If the other company is super cooperative at the due diligence stage, like no agreement's been signed, it's just talking. If they're super cooperative with like, here's the reports that we can run for your ongoing monitoring, here's everything else that the financial institution needs depending on whatever the product or service it is. If they're completely transparent, that to me says, okay, they are completely willing to do, whatever we need to do to make it work, and they want to do it right. Now, if you're working with a company that's more difficult, that's trying to be more secretive, which, a lot of times they want to protect their trade secrets and that sort of thing, which is completely understandable. But if you're partnering with somebody, a financial institution, there's ways to protect those trade secrets and still be able to provide that financial institution with reports and such that they need for ongoing monitoring during the relationship. So I think that is the huge thing that a financial institution can look for when they're partnering with a company, is just like, how transparent is that company when you're at the due diligence stage before any agreement sign. If they're being difficult, then that's just a red flag to me that you're not going to be able to do the ongoing monitoring that's needed throughout the course of the relationship.
Here's Caleb with another hot topic application of blockchain and cryptocurrency.
One thing that I think will come pretty soon, and kind of ties in with this whole future workplace, and I don't know if you guys have talked about the gig economy before and how we're moving to project-based jobs and things like that. And cryptocurrency, I think, will be a big facilitator of that, because you can pay people, you can pay essentially contract workers really efficiently, and contract workers themselves might prefer crypto because their payments instantaneous. You could potentially set up some type of third-party arbitrage decider of when they get paid. So I think that cryptocurrency payments will start to see evolve a lot as the gig economy evolves as well.
We've covered a lot of ground on the episode today, but before we wrap up, let's revisit something with Nik as it relates to the tax world that Katie mentioned earlier in the episode when discussing how cryptocurrency has evolved, and that's anonymity. Whatever.
There's one other misconception I think about cryptocurrencies out there that I'd kind of like to elaborate a little bit on. And that's this idea that they're anonymous. Really, most, I would say 98% of these cryptocurrencies are not anonymous. There are some that aim to be. An example of that is Monero. XMR is the symbol for Monero. Really, other than Monero and a couple of other cryptocurrencies out there, they're really not anonymous. And since we've been taking Bitcoin as an example, since it's the largest cryptocurrency out there by market cap right now, these cryptocurrencies are not anonymous. And in I believe it was 2017, the IRS was granted a summons of Coinbase's information on all of their users that had more than $20,000 worth of cryptocurrency between the years of 2013 and 2015. So if you think that by transacting or buying and trading cryptocurrency will help you avoid paying taxes, it's really not the case. I will say that they're somewhat pseudo-anonymous, but the IRS really flexed their muscles in 2017 by winning this case when the court ruled that they could have access to all this information. So I would just say beware if that's something that you're trying to use cryptocurrency for, is the IRS is starting to crack down on this.
Blockchain and cryptocurrency are clearly fast moving, and there's been a lot going on in this space as of late. Here's Caleb's advice on keeping up.
You probably can't keep up with everything yourself. I've been mostly focused on the financial reporting and not like the tax side of things, just from what my job is. It's changing very, very rapidly, and there's a lot of weeding out hype from realism and trying to realize where companies are actually at in the process of looking at either cryptocurrencies or how they're going to use those within their business. A lot of people have said a lot of things that are still in development. So there's accounting groups like the Accounting Blockchain Coalition that are looking into it. Obviously, all the regulators are looking into it significantly, and the IRS is supposed to be issuing more thorough guidance than what they issued in 2014 relatively soon. It's just really keeping a pace on the regulators and then what everybody in the industry is doing.
Let's conclude today with some specific recommendations from Caleb on ways to learn more.
There are differing levels to how interested you are. There is a group at Berkeley that has done a really phenomenal blockchain course that requires a significant time investment, but it's really well done. And that is offered through one of, I forget which platform, but either like Corsica or EDX or one of those. And that's a really good introduction and follow on deep dive into blockchain. Also, any of the like major news outlets that have started covering crypto. And then finally, it's just learning about each individual project, because each, whether it's Bitcoin or it's Ethereum or it's Augur or whatever it is, they all have their little quirks. And so after you've gotten a kind of a base level understanding of blockchain, you can go and see kind of how they differentiate themselves and what's unique and what's not. And to me, that's the fun part. And also, I think if you're interested in learning about blockchain or crypto and you haven't done so already because you haven't found the time or whatever, the biggest thing I can say to motivate you is to buy some crypto. It doesn't have to be much, but once you have that money invested, you'll be amazed at how much more willing you are to spend time researching it. So that's how I got into it. And back in 2016, I started investing in it. I was like, this is really cool. And I found out as much as I could.
We've reached the end of the chain on blockchain and cryptocurrency, at least for now. But you can learn more about our guests today and get additional blockchain and cryptocurrency resources at bkd.com/simplytax. You can also find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.